Okay. Welcome to another and latest edition of the Random Walk podcast series with investors who talk smart, or some better name that I'll come up with at some later point. I am very happy to have Gil Dibner with me here today. Gil founded the venture firm Angular Ventures. He's done a lot of different things. Undergraduate at Harvard, got an MBA at Wharton, started out at Goldman, has worked with a bunch of funds, and has been doing this for a while. Gil's also a frequent and thoughtful writer, which is a homing beacon for the kinds of things that I like to do and get interested in. Has some interesting thoughts on where venture has been and where it's going that are not necessarily the same as everybody else's, which is also, of course, something that I like.
Thanks so much for having me. What Angular does is, we're very much a classic VC firm, and I think we're going to get into that. What does that even mean anymore? But I think Angular is an inception stage firm. We invest in European and Israeli companies, and that can mean companies with European or Israeli founders, or companies that are started in Europe or Israel, or companies that are actually getting started in the US, but the founders came out of those ecosystems. Any of those are fine in the B2B, deep tech, enterprisey kind of space that are trying to build global businesses. That in almost every case means they're trying to build a business in the United States. My partner David and I are both Americans, and so that's our playground. We're a first check firm. I think that's another thing that we can talk about is what do these terms even mean? So we stopped saying seed fund or pre-seed fund or Series A fund because none of it means anything anymore. But what we do say is we're an inception stage firm. And what that means is we would like to be the first or almost the first check into a company. And a founder asked me what this means yesterday. I said, like, look, if you just go back to first principles, what we do is we back a small team of people, of 5 to 15 people, for 2 to 3 years, so they can get to some milestone that's meaningful. And if you multiply that number of people by whatever you think their salaries are and whatever other expenses they're going to have, that gives you kind of a range of dollars that they might need. And as long as that number is under 10, it could be 500,000, it could be 3 million, it could be 9 million, but we can lead or do all of that round. And if the number is 50 million, then we're not the lead investor for that kind of round. A small team of extremely motivated and talented people can do a lot of damage, and that has been true for many decades, and I think will continue to be true. And those teams, particularly if they're doing something that is non-consensus, illegible, weird, high volatility, like there's a place for a capital partner that's a thoughtful partner to founders in that kind of a situation, and we want to be that partner.
That's awesome. And you said there's a certain amount of money that they'll need to reach a certain milestone. Let's just say in the past that those milestones were relatively mechanical, or at least they proceeded mechanically. But what is that milestone today, and how is it different than before?
So I was joking with you that I would try to avoid saying it depends, but it depends, right? Credit to Sam Lessin for naming the factory model of venture. What he was really getting at was that for a period of time, and we can argue about when exactly this period of time began and ended, but for a period of time, follow-on funding round was almost automatic. There were a lot of people who were trying to come up with heuristics. Oh, if you get to $1 million of ARR, and sometimes it was more sophisticated. It's like, oh, if you get to $1 million of revenue and your NRR looks like this, and your growth rate looks like that, and your margins look like this, and you have this many people in the team, and your revenue per employee, then you deserve the next round. But the truth was, it was literally automatic. And I can say, as a matter of observed fact, that in my portfolio in the years 2020 and 2021, my absolute worst companies were raising rounds no problem. And in the years 22 and 23, my absolute best companies were not raising rounds no matter what. And now it's kind of balanced out. But I guess what I'm saying is two things. One is the market conditions do impact what is necessary to raise the next round. That's true. But the other thing that I think is equally true is that thinking through what that next round actually looks like and what that milestone actually means, and in whose eyes the milestone matters, is an essential part of the investment decision on both sides. Both the VC needs to communicate that to the founder that they're backing, and the founders also need to buy into that thesis. And there needs to be a meeting of the minds around what are we de-risking, and what's the experiment that we're running here.
Yeah, so I think that's so. What is it? I understand that it varies, but like if the previous lodestar or something was just like, okay, basically you're going to raise enough money, you're going to spend it to hire people and paid marketing, acquire some customers. I don't think unit economics mattered that much, but if you could just sort of show growth, then somebody else would come in. Now that's not true. So what are you underwriting? What's the experiment? It's not to get to break even, or maybe it is in some cases, but what is the experiment that they're running that will make them fundable at the next stage?
So you're going to kill me, but it depends, right? Like I think that, I really mean that. I think we have, like, if you take a step back, I think one of the things that is true, if you buy into the idea that VCs and founders are actually really partners. The founders are the operational partners. They're the visionaries, and the VCs are a capital partner. Right. Sometimes we add a little bit more value. Sometimes we're a bit more strategic or operational, but for the most part, we're capital partners, and that's the primary role that we're playing. The critical thing, and I speak from a VC perspective, but I think it's true for founders as well. When a VC makes an investment decision in a company, one of the critical things they need to do is understand what kind of decision we're even making in the first place, right? So we've become very thoughtful about this internally and attempt to be very intentional about this. Let's identify what kind of decision we're making. And for us, it kind of boils down into one of three types of decisions, right? At least on this axis of what's the next milestone. Sometimes we're investing very clearly for this has got to raise money externally because they need more money and we know they need more money and we're trying to achieve a bunch of milestones, whether those are revenue milestones or product milestones or technology milestones. But the purpose of those milestones is very explicitly to unlock external capital. And if there isn't going to be external capital, this apparently isn't going to work.
Right.
That's one set of
So in other
decisions.
words, you're asking yourself at the beginning is I need to give you enough money to reach a milestone that I can then turn around and sell to deeper pools of capital.
Well,
Yeah.
that's one type. A second type is no, the goal of this thing is to get to a set of milestones, whatever those milestones are, that are sufficient for our conviction, right?
Okay.
And a third type is we're going to get to a bunch of milestones that actually do bring you to break even or bring you to the option of break even or bring you to the point where we can get you to break even. Break even is a dirty word, right? You're not supposed to say it because what you're supposed to be doing is 10xing, 10xing. Who cares about and how much we're losing? And you have companies that are doing hundreds of millions of revenue that are still gross margin negative in a lot of cases, right? There's nothing wrong with that. As long as you know what you're doing and you have a plan, I'm not here to say that that's a bad idea. I am here to say that sometimes we've made investments in companies that were in deeply unpopular areas where if you look at that, I get excited about the business. The founder is obviously excited about the business. They've committed their lives to it. I'm excited by it because I see a pathway to making a lot of money for our LPs if things go well, right? At the same time, if you ask me what's more likely that we get this thing to a place where some VC wants to fund it, or we get this thing to a place where we can plausibly break even with a reasonable amount of capital, maybe even an amount of capital that we can fund. If I look at that scenario and I say, you know what, it's not slightly more likely that you're break even than you're fundable, but it's X more likely that you're breaking than you're fundable because what you're doing is so deeply unpopular that I refuse to bet your career and your business on the idea that some white knight is going to show up and fund you. It's not forbidden. There's nothing wrong with saying, hey, I want to maintain eyes on profitability. You can always decide to reverse that decision, right?
Yeah.
I'm just saying part of the partnership, part of the act of partnership between founder and investor is to reach a meeting of the minds on what are we doing here and what is going to be our relationship with further investment and profitability and cash flow,
Yeah.
right?
Yeah. Would you ever envision a scenario where it's like, no, the idea here is we want to get you to break even and then you can invest your profits into growth. But from your perspective, you actually don't want them to be you don't want to be further diluted. Is that a path that you want to optimize for or ever or occasionally more so than before?
It's definitely not a path that we're optimizing for, right? This is why I'm afraid to talk about this, right? Because if you only listen to a few minutes of what I'm saying, you'll conclude, oh, wow, this guy wants to invest in small companies that are going to be slow growing and not that interesting. That is not at all what I'm saying. What I'm saying is there is a certain subset of cases that can drive venture returns, but that for whatever reason, they face challenges in the downstream fundraising market that are significant. And if we can see those up front and plan around them, we should be doing that. And one of the tools in the toolbox should be a cash flow positive scenario or a cash flow optionality. I want to be a little bit more specific. If we are a seed stage, inception stage fund, and a founder comes to us with a completely insane idea, but for whatever reason, in the magic of the moment, I'm swept away and I believe in the vision and I believe this could be a multi-billion-dollar outcome that, if we hold even, 10% of it at exit, we can more than return our fund, right? Great. Venture scale. Fantastic. And the plan is to do 3 million, right? And the question is, okay, when you're out of that 3 million, what's your burn rate when you run out of money in the 3 million, right? If your burn rate at that point in time is, 100K a month, right? Then if I put in another 3 million, I can buy you 30 months. That's a
Yep.
lot. You can do a lot of damage in 30 months. You get to break even. You could raise more money. Lots of good things could happen. If your burn rate coming out of that period is $1 million a month, then even if
Right.
I put in another 3 million, you got 3 months. You're as good as dead anyway. It doesn't matter, right?
But
Now,
it's more of a
if we
mitigant than a strategy sort of thing.
no, it can absolutely be a strategy because if the cash flow dynamics of your business are such that that's a plausible outcome, then it's not a mitigant. It could be a legitimate strategy.
What's the category, I guess, of unloved to be less abstract?
I'll
Like what falls into this
give you
bucket?
an example from our portfolio. We have a company in our portfolio called Crux OCM. Crux OCM sells software for the oil and gas industry. This is incredibly unsexy for a lot of reasons. First of
Yep.
all, it's oil and gas, and even though there's deep and very significant environmentally positive implications of this particular software, about half the VCs in California are like, oh, oil and gas, no thanks, right? So that already takes that off the table. Secondly, it's heavy industry, long sales cycles. They don't want to pay recurring revenue. It takes a lot of time to get that to start to look and feel like a software business that the Valley is excited about. And in the round after we invested, we found some like-minded investors. We got a round together. Then we went out and met a bunch of investors. And this company was introduced not by me, but because I knew what would happen, but they were introduced by some other people to all the classic Silicon Valley firms. And they all gave the answers that I was expecting. No, this looks weird. I don't want to do this. I'm not touching this. This is strange. But that company is default alive today. That company is unkillable, right? That company has such large contracts with customers that they will not run out of cash. They've raised additional money. They found the right investors. We worked hard to identify the right follow-on financing. So in that case, we were able to create the scenario where they can go off and raise follow-on capital and can grow in a more aggressive way. But we always had one eye on the possibility that, hey, maybe follow-on capital won't be available. I guess what I'm saying is I think there's an over-reliance on VCs to determine if your business is viable or not viable. And I think that's a mistake. I think
Yep.
there are businesses that deserve to live even if the VCs can't see them, or even if you don't happen to meet the 3 VCs on the planet that would be willing to fund this. And
Right.
so we need to be more thoughtful about, we're building businesses here. We're not playing venture games.
Yeah. So I think that's a good distinction because actually, like, it's also like when you say it's unloved by venture. Like, there's what is unloved by venture because why? Because venture perceives that other venture doesn't love it. In other words, they're
Yeah.
underwriting to funding risks. Yeah.
I think
Which is
venture is subject to fashion, it's subject to groupthink, it's subject to career management risk, right? There's all of these things, right? If you're a young partner at a Sand Hill Road firm or a hot South Park firm, you're going to risk your career banging the table for an oil and gas software company. It's so easy to defeat that in an investment committee. Why would you do that? Why don't you just go look for the next vibe coding thing, right? Why would you jeopardize your career that way? Right? It's not
yeah.
worth it for anyone, right? And so, but if you take the extreme other example, as an early stage VC, if we find a company with a perfect founding team and they're doing a completely obviously brilliant idea that the world clearly needs and everyone agrees is a fantastic idea and everyone agrees that they're going to knock it out of the park, the post money on that first check round is going to be 100 or more. And then if you start to do the venture math on what kind of outcome is required to drive a fund returning outcome for RLPs, it doesn't compute anymore.
Yeah. Well, so why does that incentive structure then predominate? Like, why, if it's a 10 to 15-year hold, why are 2-year hype cycles so overdetermined?
So look, I think that's a fascinating. We could do a 6-hour conversation on that topic, but the short version or part of the answer. I was having this exact conversation with a really, really wise observer of the venture scene, and he said to me one word: battlefield promotions. And I was like, "What do you mean?" And he was like, "Well, in the ZERP times, all of these funds were able to raise a lot of money, and we know the story: low interest rates, good outcomes." Right? So they all raised a ton of money. And then what you do when you raise a ton of money is you have to promote a bunch of people. And so there's a whole class of VCs that were kind of minted in recent years and never really had, even if they've had success, even if they had DPI, they've never been through the whole cycle. They've never really helped founders deal with difficult scenarios, none of that stuff. They're at a point in their career where they can make investment decisions, sometimes for tens of millions of dollars at a time, but they're not at the point in their career where they can afford to screw that up, perceived as too risky because they don't
Yeah.
have a long track record of success where they can say, oh, well, I've already proven myself. The other thing is a lot of those people are tied up in funds that are way too big to ever make carry, and they're at the bottom of a pyramid of a lot of politics internally. Right. So there's a lot of incentive for them to leave. And by the way, they're leaving in droves. Right.
Yeah.
And if you're going to leave, you're particularly short-term incentivized because you're making an investment. Let's suppose you're making an investment in 2024, and you know that by 2026 you're going to be out raising your own fund because you don't want to stick around until 2034 for carry and giant fund with $7 billion under management. So what you need to optimize for is, will someone hire me in 2026, or will I be able to convince an LP to back me in 2026? So you need to invest things that are immediately legible,
Yeah.
right? You have
I guess
no
there's
interest in
sort of
slow
key
burn.
emphasis then on LPs and GPs doing the hiring and funding decisions than to be looking at other heuristics besides like near-term buzzy paper markups, right? Right? They could, I don't know what other heuristics they'd use, but you're right. They're responding to the incentives, which is
But
that the feedback loops such that they exist over-indexed to hype, even if actual returns and good investment decisions have a much longer time horizon. But be that as it may, there should be something else that people are looking for. But I guess they're not. I don't
well,
know.
it's not visible. That's
Right.
the problem. It's not visible. Even if they were to look for it, they wouldn't know how to see it. And it's funny, I'm thinking about this for the first time, so I might not articulate this well, but I think that's a fundamental change in the way private markets worked. And it's something that we've lost as we moved away from the apprenticeship model. I normally think of the apprenticeship model in venture as the benefit of that knowledge transfer from the old generation to the young generation. But the other benefit of that is that the old generation was able to protect the younger generation for enough time for their performance to gestate. In other words, a senior partner was able to say to a junior partner or even a principal, hey, I believe in you, I trust you, I'm going to give you air cover to do this deal, I understand why you're doing this deal, and I will not fire you if that deal doesn't work out because that's part of the business, right?
Yeah. Or
And
just to be more focused on process than outcomes anyway, right? Like in other words, I've watched you do the
exactly.
work. Yeah. I mean, I guess like the flip side of it to be charitable, I suppose, is you might say that like hype is a cost of doing business, insofar as your customer are founders and your ability to acquire them, it lowers your CAC to be buzzy, right? To be top of mind for everybody. So, maybe I don't
It
know, maybe that's one
well,
way to think about it.
I mean but it lowers your CAC of the venture dollars for the founder perspective.
In other words, no, if you think of your outbound as you want to get a certain number of shots on goal in front of founders, that can be relatively more or less costly. If you're very prominent at a something that's very buzzy, then founders are going to know about you and they might come to you.
Potentially, but I think the power law works in the inverse as well, right? In other words, I could optimize buzz for the rest of my career and I'm still not Sequoia, right?
Yeah, that's true.
So, right. So what it does is actually raises my entry costs to an unsustainably high level. I'm
Yeah, and,
basically
and
right.
all right, you don't want to be competing with Sequoia.
Well, not in places where Sequoia should win.
Yeah, that's a good segue because I want to shift to the swim lanes idea. This is something you've written about and relates back to what Sam was writing about. What are the swim lanes?
So in my piece, there's five, right? And I'm talking my own book here, but I believe in this. Otherwise, it wouldn't be my books. We are inception stage. There's a group of funds that are in that bucket of like, okay, we will write the first check, but that first check doesn't have to be small. That first check could be larger. It doesn't not a pre-seed check. It could be anywhere from 0 to 5, 6, 7 million, right? The next stage above us is what I would call the new Series A firms, and those are firms that will write the 10 to 20 million dollar check. That's their bread and butter. They're just like us. They're company builders. They run concentrated portfolios. Their funds are slightly larger than ours, maybe double the size. Inception funds tend to be kind of 75 to 200, and these Series A funds tend to be kind of 200 to 500. That's kind of their size bucket. And at the very top end of the scale, the third swim lane is the sort of super scale platform funds, Light Speeds of the world, Andreessen Horowitz of the world, and they're fantastic funds, by the way, and they offer a lot of value, and they're pretty good, at least historically, in investing across the life cycle. So they're great firms with deep pockets and whatever. They can play a game that very few other funds can play. They can write the $100 million check. They can write the $200 million check. Right? There's two other swim lanes which I think are interesting. One is the kind of funds that are kind of stuck in the middle between the Series A funds and the superscalers or the superscale
The
platforms,
platform, the
right?
multi-strats.
Yeah, these are like funds that are sort of in the 500 to a billion range. And I think a lot of them don't really have the skill set or the capacity to do the Series A and Inception kind of funding. They're too big to do that in a reasonable way, but they're also not really big enough to they can't win on the size. They can't write the $100 million check. A $50 million check is a lot of money for them. So I think they're getting squeezed out. Either most of them are gradually dwindling away, in my opinion. Some of them are trying to scale up to be north of a billion, so they can compete in that category, use
So where
capital
did they
as a
used
weapon.
to play where they no longer can? Or is it just that there was
I
just
think
more to go around before?
I think everybody's fund sizes have gone up. And by the way, the fifth category are subscale funds that are like sub 50 that I think are offering very limited value in most cases to founders. We can talk about why. But
Okay.
I think the answer to your question is that now that I'm a GP, I can see it, I can feel it. There's a constant temptation, almost pressure to increase your fund size. And some of that is natural and healthy because you want to have more resources to back up your companies. I mean, if you look at our funds historically, even the number of quality companies in our portfolio, our funds are massively under-reserved. So we're learning the lesson. We need to make our funds slightly larger. Right? But there's a big difference between slightly larger and like, oh, let's go from like being a $200 million fund to being a $600 million fund. It's a big deal. And a lot of these funds have then started to raise like massive select funds, opportunity funds. They're usually doubling their fund size. So in a given cycle, they'll say, oh yeah, we have a $200 million main fund, but now we have a $200 million growth fund. Those vehicles are so big because of the fee incentive to make them bigger. They then say, oh, well, we're going to also do net new positions that we missed. They're not using that capital purely to invest in their best ideas or concentrate capital. And those vehicles are so big and they're investing at such high valuations that they're way out of their league. It's one thing to invest at like pre-seed, seed, and A. It's another thing to invest in the Series F. Some of these guys are investing in their select funds in IPOs. It's completely bananas.
Yeah.
And so I think one way of interpreting that is that these firms are kind of opting out of their stage. They used to write $10 million checks, but they've kind of opted out. Now it's easier for them to write a $35 million check than a $10 million check. And that just changes your calculus. If you look at some of these firms, I don't want to name names, but they've basically opted out of being venture capital firms at all. They're managing so much money that they've just chosen another path. And when you calculate the fees on a multi-billion dollar fund cycle, which you're raising every 2 years, you can understand why.
Yeah. Yeah, but also like again, the multi-stress they are doing different things. It's not all venture, but as you say, like they're big enough and they're talented enough and they have enough coverage that they can still meaningfully compete. It may be a blended return profile that's different than traditional venture, but it's not crazy that they're doing PE style roll-ups at the same time as they're doing some growth equity and maybe even, IPO. But I guess it's what I want to focus on is two categories, two out of the five categories that you think are withering away. And like one of those, which is that sort of subscale pre-seed, but the other one is this the category of like bigger than the 200 to 300 million Series A fund. They know where they sit. Somebody else has done the work of overturning the cards to product market fit. Then they need a $10 million A where they get meaningful ownership. But there's this other class that is not quite multi-strat. So what is happening to them? They used to bid alphabet soup rounds. They would do the Bs to the Cs, but now they can't write big enough checks for As. But when there is a good opportunity, they're getting blown out of the water on price by the big guy. Is that what's happening?
And I think some of it may be due to the constraints of their own fundraising. In other words, they could be in that category because the market has moved upscale so fast that even if they went from a $500 million fund, let's say, to a $700 million fund, and they would have said to themselves, oh, this was a really successful fundraiser. LPs are buying our strategy. We've increased our fund size by 20%. That's fantastic, right? Reality is they're now competing against funds that are $3 billion or $2 billion or $7 billion. So I think it's just hard for them to compete in either category. It's actually difficult for them to compete with us. Founders are smart. They know that a fund who's writing a $10 million check out of a $700 million fund is just not going to be as attentive to that investment. And they also know that they don't have the deep pockets to really support into the next round. So it just becomes, if your goal as a founder is to, I would like deep pockets, I want to have support, I want to raise a $100 million round next time, Andreessen's a great choice. They have that capacity. There's data that came out this week that talked about the rising percentage of rounds that are led by the same firm that priced the previous round.
From the founder's perspective, you're not quite big enough to have the logo and deep pockets of the multi-strats, but you're too big to be a true partner and know that you're going to be with it through thick and thin. So they sort of get stuck in between.
I think there's a huge number of GPs, a lot of them are great people, that are, for whatever reason, departing from their multi-billion dollar platform funds. I think it's politics and they're not going to see carry. Number one. Number two, they've made enough fees that they can afford to do this. And a lot of LPs are also quietly rebelling against these enormous funds.
Okay.
But those LPs, they don't have the skill set to go evaluate a small fund like Angular, and certainly not a tiny $30 million fund. So they're like, look, I was an investor as an LP in this big platform fund that I trust. And two of the GPs from there are leaving to go start a $300 million fund in which I can put a $30 million check and own 10% of that Series A fund. And they're going to tell a story, is a legitimate story. They want to get back to basics. They want to go back to doing real Series A. Those funds tend to be 200 to 500 because they have the benefit of the spin out categories really attractive to LPs because it reduces a lot of the diligence burden on them and gives them a lot of air cover and comfort to take that to committee and get it done. And I think it's a nice way of recycling out of some of these enormous funds. And that's another reason why you see a lot of these funds running to the Gulf or other sovereigns because they are trying to raise enormous sums of money.
Money is, yeah. But that seems to me almost like LP laziness too. It goes back to that incentive problem, which is like they're trying not to get fired. They don't want to have to do a ton of homework, so they index to what's legible. In this case, that's just logo.
Totally.
But that's it's kind of funny because they're like, well, I got tired of that logo and what that firm was doing, so I'm just going to hire somebody who leveled up within that. Yeah.
I think it's just like the venture business, right? I mean, I used to use the words selection versus access, and I think it maps pretty closely to legibility versus illegibility, right? And the business of investing in illegible stuff is just fundamentally different than the business of investing in legible stuff. We love doing illegible stuff. That's why we're excited to come to work every day. It's incredibly rewarding when that stuff becomes legible eventually, but it's also very painful because it usually doesn't work, and that's normal.
Yeah. And the importance of legibility is that it then becomes more attractive to bigger pools of capital, right? That are, slightly more risk averse or at least want less.
Yeah, I mean, look, I think that's true. That's clearly true. But I kind of want to add a nuance to it. If you remain illegible forever, you're just wrong, right? So at some point, you have to become legible to be reasonable, right? Like even the most bizarre business in the world is pretty damn legible if like there's cash flow. You want to eventually meet cash flow. And if you meet cash flow, you meet legibility. And then the question is, okay, well, how far before we get to cash flow can we predict? Do you become legible to enough people? But in theory, if you become legible to enough customers, you don't need investors.
What's an example of an illegible that became legible? And then I guess the flip side, what's something that stayed illegible, I guess, for too long?
I can't remember the name of it, but there's a company that went public having raised very little money. And my partner David did a deep dive on these guys because they're a good analogy to something he's working on. But they were in the business of building sort of offshore supply vessels they were like dredges or something, like big deep sea dredges. And they had this really convoluted financing structure where they could basically build the dredge and then move it around the world and then deploy it. And they just became a cash flow machine. And they never raised any money because it's a completely crazy idea.
Village Global,
yes, I think. Something global, not Village Global, but that company. That is a great example of a completely insane business that just has absolutely fantastic cash flow dynamics and is a super incredible business. And the interesting thing about that story is that when we tell that story, you can see people's faces just glossing over there. After about a minute, they don't understand what we're talking about or why we're even talking about it. And it just proves the illegibility point, right? So there's plenty of businesses that remain illegible for a while, and then they become legible to other people. But I think you see private markets being willing to value revenue a certain way and public markets not so much because the public markets guys know what EBITDA is and they know what free cash flow is and they look at this and they're like, there's no way in a million years this makes sense. And so we're going to give this thing a multiple of 3. And the private markets are giving a multiple of 300. And at some point, cash is king, right?
Yep. I mean, at some point, it's got to be a real business, right? And a business means, by definition, it earns more than it spends. But
I joke to myself that we should call our select fund the RFB fund, the Real Effing Business Fund, because I have this fundamental faith that if you manage to build a real effing business, it will be okay. It may not be the world's largest IPO, but everyone will make money. And as one of my bosses used to say, I never lost money while making money, right? Now, yes, you have to swing for the fences. Yes, you have to swing for the outlier outcomes. But I think the issue is that if you're investing where we invest, like if I'm going to be brutally honest, I've had a great track record. I've had a bunch of unicorns, all true. But if you are investing in pre-revenue, to sit there at pre-revenue and make prognostications about how many $10 billion outcomes we're going to have when we're not even at $1 of revenue is insane. Yeah. Like, what we talk about is
what are you writing for? Like to say like,
well, what we underwrite for is $100 million of revenue. Now, I know companies with $100 million of revenue that are worth 0 or close to it. I know companies with $100 million of revenue that are worth $8 billion, right? It's that's a function of profitability, management skill, market sentiment, multiples, competition, a billion things that when you're talking in day zero, there's no one on the team yet and no revenues and no product yet, I can't predict those outcomes. What I can predict is the possibility of a high valuation and the possibility of getting to $100 million of revenue. Can I envision that? And is there a possibility that these margins might be defensible because the tech is good enough? If that's true, and we make a bunch of bets that kind of look like that, some of those things will become large, hopefully multi-billion-dollar outcomes, and some of them will just become real businesses, and some of them will fail. But I had a meeting with a founder today where we backed the company with another very well-regarded fund in the US, and then two more very well-regarded funds in the US came in after us. And we thought, oh, great, we did this amazing seed round, we're home free. A lot of things went poorly from that point on, and we put in more money, a little bit of money, to help that guy get to break even. And the motivation there was multifold. It's the right thing to do because he has a pathway to break even. And if he gets that company to break even and he sells the company even for $10 million, for him and his family, it's a huge important outcome. And it's the right thing to do. And it's $200K from our fund. By the way, I sat with an LP of ours and I gave this as an example of discipline. I said, oh, we're not going to back this company because I'm disciplined. And he was like, are you kidding? Of course you should back this company. I was like, what are you talking about? And he was like, it's $200K. No one will notice. It's $200K that takes your ownership in that company from 10% to 25%. And that means that on a small 40 million fund, if the thing exits for 40 million, you return a quarter of the fund, which is not bad for 200K. Secondly, it's the right thing to do. And thirdly, he's going to remember you forever. He was like, is the founder fantastic? I was like, yes, the founder's fantastic. And I know he's fantastic. He's been carrying the entire company on his back. And so this LP said to me, if he ever starts another company, would you back him? I was like, in a heartbeat, I'd back him. And he was like, then of course you should do this, right? Because you're buying future deal flow and you're buying reputation, you're buying all that stuff. Now, I met with him today and he's got a plan that first of all, he's 10K away from break even. And he's got a plan that's actually interesting and we might even raise money. And all of a sudden it's gone from being a smoking crater in the portfolio to being something that might actually be a thing. And more importantly, a relationship that's a relationship that matters. And the outcomes for his family are not zero. They're something more than zero. And that's, that is not a rational, it's not an entirely rational decision. It's a little bit more than just rational. And this is why I'm not worried about AI, by the way, taking our jobs. Because at the end of the day, it's a human-to-human partnership where I'm backing it because I know how hard he's working. I know the guy hasn't slept in 3 years. And now we're seeing the fruits of that effort. And if that thing turns into anything other than a zero, which it probably will, it's an incredible story that is actually financially meaningful to our LPs. Because even if we sell it for, even if we sell it for 20 and we get back 5 million and we can recycle that 5 million into other companies in the portfolio, that wipes out all the fees in our first fund. That could lead to massive uplift in our multiple on the fund level. And that was all for 200K. And I don't know if this is helpful, but this is kind of how I'm thinking about it.
I mean, it goes back to the legibility point, which is some of the the NPV or the value of what you're doing. The upside isn't entirely legible either. Which you could lead in other words, brand loyalty. It's there, it's real. It's just hard to count.
Right, for sure.
It maybe it gets undervalued by other people. I'm curious. I want to ask about AI a little bit more, but there's something you've written about in terms of how you underwrite founders. And one of them was something you referred to as earned insight, which to me is sort of the Peter Thiel-like thing. They know something about the world. They have a secret about the world that other people don't have. I would flip the question to you: what is your earned insight, or what is your Angular's secret about the world that other people don't have?
That is a good question. If you look at the swim lane thing, I think we put ourselves in a group of VCs that really does see it as a calling to work with builders and help them build and not play momentum games. Obviously, momentum is a wonderful thing. It's great when we have it. I'm not against momentum. But I think at the end of the day, we create value in the economy and we create value for our LPs by investing in illegible companies. And I think the only way to do that successfully is to get close to them and try to understand, try to be the one that can read the otherwise illegible and help them navigate that and speak truth to them. And sometimes you get into trouble because sometimes you say things to founders they don't really want to hear. They're not ready to hear. I say it in the wrong way. I mean, that happens all the time. But I think that spirit of partnership where you take that really seriously does matter. And I think that is an earned insight over time. Another earned insight over time, And this is kind of, again, I don't think it's not the sexy part of VC, but I think this intrinsic understanding of cash flow in both directions. In other words, if you're building a business that is cash flow negative, it doesn't matter in most cases, even if it scales massively. I don't know how to do that. There's other people that can do that. God bless them. That's not what we do. Right. But I think the flip side is also true. If you build a business that is fundamentally has good fundamental cash flow dynamics, and you can then figure out a good growth lever that's predictable, the upside to that is unlimited until that stops working. And
Yeah.
so we have a number of companies that were literally on death's door. One of them is a AI software business. The other one is a logistics business. The other one is a data infrastructure company. Just traditional software companies that for whatever reason were overlooked, and they screwed some things up, and they hired the wrong people, and they did the wrong things, and they sold the wrong way, and they couldn't get their go-to-market machine working. But I genuinely believe that we played a role in guiding them to a place. They were on a pathway to guaranteed death because they were not going to raise externally and they were going to die. And by the right level of coaching and the right level of encouragement and helping them to focus on the right things and having the right interpersonal communication with them, I think we played a role in navigating them to a position where they have turned their non-businesses into businesses. I had a founder tell me last month at a board meeting, I'm default alive for the first time. As of next month, I'm going to be profitable. And then in Q4, we're going to raise. And this is a company that was begging me for more capital 6 months ago, or sorry, 12 months ago. And I had to say to him in that situation, no, I can't justify putting additional LP capital into you right now. I might be able to do it in 9 months or something, but I can't do it today. I believe you have a path to break even if you do the following things. And he did those things. And now he doesn't want that capital at that price. And he owns a lot more of his business today than had I done that. It would have taken the pressure off at exactly the wrong moment. Now the guy's Rambo. Now the guy's unkillable.
What were the? Can you be more specific on what the changes were, or is that too in the weed?
No, the changes were just, look, I think these things are usually like sometimes it's simple. Sometimes it's about reducing headcount and focus and those kind of things. In the case of this particular company, I think it had to do with the founders realizing that founder-led sales wasn't just a buzzword. They had to do it. And not only they had to do it, they had to succeed at it. And he started optimizing for success at it. And he sort of ran the numbers and he was like, okay, I need to close this much net new ARR every month on average over the next N months to get to break even. And I want to get to break even because if I get to break even, I don't have to do a fire sale. And if I get to break even, I have infinite runway and then I can raise money later. And if I get to break even, maybe I can go back to Angular and they'll give me more money to invest in growth because now I'm not going to die. Right now they know they're going to get their money back and they can give me more. And he then did that math and then he optimized for success. So he came to me one day and he said, Gil, I'm going to stop selling deals larger than 50K. And I was like, that's interesting because you had some 100K plus accounts. Like, why are you going to stop selling those? He's like, because I want to optimize for velocity. I was like, oh, that's interesting. And he was like, I want to not waste any time making a deal go from 50 to 100. I want to get as many deals done at 50K as I can because I think I can predict that I can get enough deals done at 50K to make this work and they'll upsell later anyway. And I was like, okay, that makes sense. You're optimizing for something and it's based on your insights on the market. It's based on your conversations with your customers and your understanding of price point, and your understanding of willingness to pay. And that made sense and that worked. And he built a predictable, repeatable motion at that price point. Now all bets are off. Now he could raise the price point, he can lower the price point, he can hire new people, he can do all these things. But he figured out how to focus on the single activity that he had control over that would bridge the gap. And the other thing that's interesting is when he comes out of this process now, having been through the valley of death, right? No sales guy can ever bullshit this guy. This guy, as long as he lives, even if he raises $200 million from here on, he's never going to waste a penny. He already hired an enormous go-to-market team and fired all of them, right? He's already been through that movie. He doesn't want to be there again, right? And he's a different person. He's in a beautiful, amazing way. And so now time will tell if the business succeeds or fails, but it's not a zero. It's something. Yeah. I think a lot of VCs take the view of, oh, well, I have a portfolio. I only need 2 to win. I think there is value to our LPs in that human engagement because it does set you up to make the right calls to deploy capital in the right way at the right moments. And it does, and you end up with significantly more shots on goal than you would if you just ran it full tilt the other way.
I mean, it's the survivability. If you lose that, everything goes to zero, right? So there's just so much upside in just staying alive. Do you think like there should be more cross-pollination in the asset classes? You started at Goldman and like thinking about earnings and profit relative to just revenue growth, and even the story you just told, like would venture benefit from other investors?
I think venture has become a bit of an echo chamber. And I think a lot of it comes down to like, are you in the access business or the selection business? And we're squarely in the selection camp. But that means that we're out in the desert for longer because we're gravitating towards weirder things, right?
Yeah.
Like we're not competing for the hottest deal we can find. That's a different business.
Yeah. Like, even then, I guess, like, let's talk about liquidity for a second. Like, is there some fix? What is the current state of play? Is it the bid ask is just too wide, but it could be narrowed, or the bids are out there, there's just the market isn't being made, or is it just actually there's no bid for companies that are.
I think the bids are out there. I think, we've had two acquisitions in our portfolio in the past, few months, actually three. On one we lost money, on one we made a bunch of money, on one we broke even. So the buyers are there now. That was not true a year ago or 2 years ago. And that was another, call that we made. A lot of our co-investors were trying to push these companies to exits, fire sales to get them off the books. We had a company like 2 years ago was acquired for $0. The acquirer agreed to assume their debts. That was the deal, right? And I looked at the founders who were in that position. I said, look, guys, you can try to run an M&A process here, but odds are you're going to get zero or you're going to get nothing, right? And so let's try to survive long enough to be able to run an acquisition process that is interesting. And some of those managed to do acquisition processes that are interesting. And some of those are now want to raise because they figured it out. It's so specific to particular companies. And I think one piece of advice is that founders do need to be running the M&A playbook constantly, even if they have no intention of selling, because it's a great way of building partnerships. It's a great way of creating alternatives. It's a great way of getting VCs motivated. I mean, we have a company that like turned down acquisition offer, and it helps with VCs because they, the guy says, look, I had an offer and I didn't take it, right? There's a valuation to what I'm doing, but I want to build something bigger, and it can only help you.
Should
And you
startups
can't,
be doing earnings calls? Should there be more of a dedicated IR function where they're getting and putting information out there? That's not just necessarily in the context of like, okay, now we're running a process and there's a data room and everybody who sees it as
yeah.
permissioned and it's closed to close. Like, is
You
there
mean
some universe where.
do you mean for fundraising, or do you mean for just updating the public on what's happening at large
Well, I
startups?
mean, like, if part of what you're saying before is like be constantly running an M&A process, I think one of the insights of public markets is just like there is information isn't always baked in. And you put information out there, you can actually get a lower cost of capital because it reaches more people. If you tell your story, you shouldn't necessarily just be
Yeah.
telling the story to the VC that you pitch, but maybe that's not true.
No, I mean, look, most of our focus is on very early stage companies where the whole idea of an earnings call, I mean, even the idea of a board meeting is a little bit of a fiction, right? We're so close to these guys. We're on WhatsApp with all of them several times a day. One of the things I've learned, for example, is that I'm very friendly with founders and like too chummy sometimes because the board meetings are just like it's a Zoom call with a bunch of friends and we're talking what's going on. And I often find myself saying, look, I'm going to sort of force you guys to report as if this was a real company because eventually we're going to have to be. And so we might as well start now. And a lot of times I've learned to also invite a third party to the board meeting, some kind of non-investor, non-founder to the board meeting. So it feels more balanced and it's not just a single dialogue between the founder and the investor, but it's an actual conversation between various people with different opinions because it's more healthy.
Right. And then the performance sort of changes a little bit. You have to be a little bit more buttoned up and it can't just be friends kind of thing.
Right. And there's a witness. There's a witness. It can quickly devolve into an argument or a discussion or just an agreement fest where we're disagreeing with each other. And if there's a third person in the room who can stop us from disagreeing with each other for an hour, that's helpful.
Some of the AI stuff going on right now, like, do you have a contrarian view there? Do you think that the prices are just repeating the mistakes of 2021, or like, is it too early to tell? Like, how do you even underwrite those businesses when it's changing so quickly?
Look, the short answer is yes and no. In other words, AI is a real thing. There are some real companies being built that are really interesting and are growing super fast and deserve the valuation that they're getting, no question. At the same time, a lot of VCs are reverting to type. AI is giving them a really convenient excuse to shove a lot of money out the door really fast, which is justifying large fund sizes, making it, if your business is deploying, $3 billion over a 2-year cycle, you better deploy $3 billion over a 2-year cycle. You can't raise your next fund. And if you don't raise your next fund, you don't get more fees. And so there's a lot of incentive to tell a lot of stories to a lot of people to justify a lot of deployment, and the cows will only come home years into the future. And with 2.5 or 3% fees on multiple billions of dollars, especially if you've convinced yourself, but even if you haven't convinced yourself, there's a lot of incentive to do a lot of bad behavior. And I think we're seeing that, regularly.
Yeah.
So it's a particularly weird moment in the venture space right now.